Uh, so good morning. Thank you all for joining on this Saturday afternoon. Uh, so the topic for today's webinar is the number one investment behavior that destroys wealth, and almost every investor does it actually. So one of the main thing is that these are not investment mistakes where our research or strategy is wrong. Those are secondary, but primarily uh, these mistakes, which almost every investor does, is actually a behavioral mistake. So the behavioral mistakes are the main thing which causes loss in the portfolio, even if the investment has actually performed well over a period of time, because we would have done something differently because of the market reaction or the market volatility. So these are the common mistakes, and we are going to, briefly see on this behavioral mistakes that the investors does. So because the reason for doing this webinar is also, this kind of mistakes are mostly done by the investors during these time when markets are very volatile, when most people don't know what to do, which asset class to shift. They don't get the proper guidance, and since most of them are nowadays handling their portfolio by themselves, we just wanted to give clarity on what to do at this point of time and what mistakes to avoid, so that because investing at times like these and investing in correct investments at times like these and holding on to it for next couple of years or 3 to 5 years, you will make actually good returns than what investors invested in the last couple of years, because the markets won't be giving you returns in a consistent manner. So just like how an FD gives. So in equity, the returns would be mostly linear, right? So it will always be a very bumpy phase in equity. So like I said, the biggest wealth destroyer is not bad investments. It actually bad behavior. So when investors does these behavioral mistakes, their investments returns would be slightly lower than what the actual investment would have given yielded. So this gap between the actual investment and the investor's return is what you call as behavior gap. So this behavior gap is it's due to the mistakes done by the investors. These are not research or strategy mistakes. These are mistakes which we make due to our emotional decisions actually. So just to give you an example, you know, uh, let's say you would have invested in a stock or a fund, and if that fund has actually would have given 100% in the last 3 years, but for you it might have given only 50 or 60% return. The reason being it is maybe you would have thought that after 30% you would wait for a correction, so that you would have sold it, and you would have waited for the stock price to go down. But whereas at that point of time, the stock would have gone even more higher. So you would have actually, you should have been waiting in the sidelines, and there might even be a situation where you would have actually buy at a higher price than what you've sold actually. So these are the common mistakes which happen, and these are the reasons why this behavior gap, the return, the return difference between the actual investment return and the your investment return happens. So another interesting data point that I wanted to show is that uh, there was a article released by Bloomberg, so where they say that uh, if you would have missed out on the best 10 days in the market in the last 30 years, your actual return would actually be half. Let's say, for example, here they've given that the S&P 500 index, the SPX, in the last 30 years, the average return, the annualized CAGR is 8.4%. But whereas if you would have missed investing, or if you would have not invested in the best 10 days, right? Or if you would have actually not participated, meaning you would have sold and you would have waited in the sidelines, then your returns would have actually been halved. It's almost 5.6%. It's almost like 60% of the 8.5%, 8.4%. And if you missed the best 20 days, your returns would actually be even less than half. It's almost 3.7%. And if you miss the best 30 days, it's 2.1%. And if you miss the best 40 days, it's 0.7%. So, being right or wrong is secondary. Being in the game and actually investing is the primary thing. So most of the people would actually be waiting for a correction, so that they think they can make good returns. But actually, you need to be in the game. Being in the sidelines and waiting, they would actually be waiting, and all they would do is just wait. You just need to start investments, and you can maybe even do it in tranches, or you can even do it in small portions. So that is what one thing you can do instead of investing all your amount in one go. Because a lot of people, the markets was correcting in the last month, almost for almost 15 days due to this war situation, and most people didn't know how much to invest, and a lot of questions were coming, if they can actually sell their investments and move to FT. So if you would have done these mistakes, and let's say for example from here the market goes up, actually you would be in a situation to buy your investments at a higher cost than what you've sold. And this kind of situations can happen. So the reason, so I just wanted to give you this data so that you can hold on to your investment. So the main thing is we need to identify correct investment opportunities, and we need to have the stomach to hold on to your investments for a very long period of time. So that is one important thing that I just wanted to know, uh, to make you aware. And this is another thing. So generally in equity markets, a lot of people think that the returns would be actually. So another thing that most of the investors have in mind is that they think equity returns are kind of consistent, just like how a FD or a bond return works. But it's actually not like that. Equity markets move in cycles. There will be phases where there will be aggressive returns, just like how the 2021, 2023, 2024 markets was giving returns. And there will be phases where there will be no returns or negative returns, like 2022 or 2024 to 2026, or even now. So the returns in equity markets will actually be lumpy. Most people think that once they start investing, their investments needs to grow by, at a certain percent, at least like a 12 or 13% every year. But that's not how things work in equity market. And most people don't actually invest when markets goes down and their portfolio goes red. So people think that they'll start adding more money when, the markets comes back, so that they'll be more confident to add more money. But that's how most investors behave. But you actually need to do the opposite. So most of the investors are afraid to invest at these times. But actually, to make that extra 2-3% alpha, investors actually need to invest aggressively at times like these, because obviously all the valuations are have gone down, and in the mid and small, I mean small and micro cap space have been beaten down, and this is the time for you to be aggressive. But generally, the reaction and the investors take high risk when markets are at a higher valuation. So actually, I just wanted to inform that you just actually need to do the opposite. And another thing is, uh, there is a common uh, relationship between the mistakes and the emotional attachment you have to a particular stock or a particular investment. So the more emotionally attached you are to your investments, the higher the chances of you of making a mistake in your investment. And another main mistake is that a lot of people actually invest based on the past performance. They think if the fund has delivered a 20% or 24%, 25% CAGR, they think in the future also they'll do at a similar pace. But actually, it's not like that. You can't predict future returns based on the past returns, and past returns doesn't guarantee future returns. Let's take an example of gold and silver. It's a classic example, and it happened recently. Silver moved up by almost 200%, and gold rallied almost by 150% in the last year, right? In the last 2, 3 years, gold and silver, the precious metals have rallied a lot. But what people did was, at the top, everyone started buying gold and silver because they thought since it has rallied so much, it will also rally even further. And they started investing heavily. The retail crowd invested heavily at the top. Even there was one data which showed that the inflows in gold and silver ETFs was even more much higher than the equity inflows in January 2026. So these are some of the common mistakes which people make. Another classic example is due in the midst of the top 2024 top, and even in 2025, people were chasing small and mid caps like anything. And you know what happened? In the last 2 years, the small cap has delivered negative returns, and investors haven't made any money. But that was the time to invest in gold and silver. And at that time, gold and silver's return was not that high. So at that time, when we suggested gold and silver, everyone thought that why should we invest in gold and silver? We want some alpha, so that we want to invest in small and mid cap. So, but now, since small and mid cap have delivered negative returns, some people would be afraid to invest in small caps. But you can start, actively speculate in small caps. Maybe it's not even now valuations are high, but maybe you can start tracking small caps because the valuations are coming down. And still, as a house, we haven't suggested any small or mid cap funds even now. But maybe if market goes even lower, maybe we might do. Our strategy team might suggest. So another thing is most of the people, you know, they buy at the top and they sell at the bottom due to the fear. And if you do it, you'll actually make negative returns, and you'll actually be booking loss. You'll be realizing loss. It's a loss only if you realize it. If your portfolio is down in the future, when markets eventually goes up, you'll make returns and you'll book profits and you'll make money. But if you realize it if you realize loss, then you're actually made the actual loss. So another thing is, yeah, another thing is, you actually need to have a certain plan on your investments. Actually, most of the people, they just invest randomly. They take higher risk. They don't actually have a goal or a plan in their mind. It's not a very process driven. So what we you can do is you can actually set goals for investments, and most of the people would actually have a certain commitments in certain years and goals. So you can invest through mutual funds, and you can achieve those goals. So maybe what we do for our mutual fund or PMS clients is that we actually create a financial plan, and based on the financial plan, our clients invest so that they reach their goals in a timely manner. And it's a very smooth process because you are very well organized on in terms of what you're doing and where you will be. So you have a proper vision. So our MW investment model is that in markets like these, in the last 2 years, the markets have been very boring. Almost like 16 months, the returns was flat. The markets was flat. It was just going sideways, and now it has almost corrected by 10%. So at these times, we encourage clients to do lump sum, and they can also increase their SAP as well, so that when they average at when the costs and unit price are cheaper, they can create much more alpha, and they can reap the benefits and the market tops, so that we'll even inform the clients and where we can book profits. So another thing is, in terms of you know becoming a big investor, is that uh, in initial years, to build the base or to create a bigger portfolio, it's very difficult. So be it as an investor in the initial few years, you just need to forget the returns that your portfolio makes, and you just need to be focused on in terms of your savings, and you just need to be focused on how much you want to invest. Your investment value should be the first focus actually. So you should first have a target on how much to invest and how fast you can you know go to the first 1 lakh or 2 lakhs, and then you need to focus on how faster you need to reach the first 5 lakhs and the first 10 lakhs. In creating the first 10 lakhs is quite tough, because you'll be obviously most of us will be starting at a smaller amount, and maybe some people can do higher SIPs, but let's be honest that almost more than half of the people will be able to invest around 10 to 25,000 per month. So it will take at least 3 to 5 years of time. So first building this 10 lakhs is quite tough, but after that, the compounding effect comes into play. Let's say, for example, the 10% of 10 lakhs is almost 1 lakh, right? So 1 lakh would be higher than what you'll be investing in the first 6 months or first year, right? So after the 10 lakhs, maybe you should, after 10 lakhs also, you should, uh, keep adding money consistently. But, the compounding effect will also start helping you once you reach the 10 lakhs. And, uh, in the in terms of MPW, the main reason for you to invest in MPW is to reach the 1 crore. But the actual advice from our team would be that it will be better and it would be great if you can invest 1 crore as total in terms of your whole investment journey. Because if you are able to invest 1 crore, right, then definitely, even if we compound at 12%, you will be easily able to achieve 2 crore, around 2 crore, 1.8 to 2 crore in 7 to 8 year period of time. And we have an upgraded version called MPW Accelerator, where clients can actually, if they're able to invest 12 lakhs per year, or at least 1 to 1.25 lakhs SIP per month, they'll be easily able to invest. Their invested value itself will come around 12 lakhs to 15 lakhs. At that point of time, let's say after 7 or 8 years, your invested amount will itself be around 1 crore. So, right. So even if this 1 crore compounds at 12%, you'll be able to reach 1.8 to 2 crores. So this is one MPW accelerator which we have brought in new for our clients. So if you're an existing MPW client, and if you feel that you can do more, and if you feel that you're doing less than your potential, maybe you can upgrade to this MPW accelerator. So that is one thing we wanted to inform you. Thank you all for joining.